Right now, there is a trap hiding in mutual funds that nobody talks about. Everywhere, people tell you, pick funds, save, but no one ever tells you that the literal way they operate can put your money at risk. And if you've been investing the last few decades getting ready for retirement, that's risk you don't want to take. As wealth managers here at Ironwood, Alex and I have seen funds implode in real time, wiping out millions because of this. But here's the crazy part. The managers are legally forced to operate this way. When the market panics, their hands are tied. They literally can't step in to protect you, which means the only one left holding the bag is you. So in this video, we're going to expose the 3 hidden dangers lurking inside your mutual funds so you can stop bleeding wealth and finally protect your money. First, we have to look at how these funds actually buy and sell stocks, because if you ignore this, you could be bleeding money behind the scenes and pushing your retirement date back for no reason.
Yeah, and this is something that a lot of people don't talk about because it's not in the literature. It's almost like a hidden expense, but it's not actually an expense. And what I'm talking about is when you look at a huge mutual fund, typically these things are actively managed, which means the managers go out and make decisions. And let's say manager of a mutual fund says, I want to buy XYZ stock. How much are they going to buy? Are they going to buy $100? No. Maybe they're managing billions of dollars. They're going to buy 50 million, $100 million. And they're not going to just go out and click buy and buy $100 million worth of stock today. What they're going to do is they're going to buy it in chunks. So we have 2 problems here. One is you're paying these people to make decisions, and then their hands are tied because they can't do it when they want to do it. So if let's say that we want to buy XYZ and our fund is big enough, we're buying a big enough position, it could take months to buy that position. By which point the reason we bought it may not even be relevant. And what happens if we buy it quickly? Okay, I like to use the example of an elephant on a raft where, if the elephant goes from here on the raft over to here, the raft goes like this. He walks back over here, the raft goes like this. So what I mean by that is that if a fund manager is buying something at $100 a share and they click buy on one of these massive buys, they'll get some at $100 a share. Then it'll be 125, 150 cents, 101, so on and so forth. And the same thing happens when they want to liquidate a position. They can't liquidate it all at once. And if they do liquidate it too quickly, they're literally driving the price down as they sell it. And this is something that costs investors money. Again, it's not a fee, it's not an expense, you don't see it, but it actually does cost you total return.
And you can totally see this over time, because why is it that some of these funds are underperforming their benchmarks by so much? So you just have to realize that the way mutual funds are built, it forces you to pay too much or sell for too little. But it's not just your stock funds. The exact same problem is in your safe bond funds, the things that you're relying on for safety, and it really turns them into a ticking time bomb. Because if you're counting on bonds to protect you during a crash, which is the whole point, that false sense of safety could cost you everything. And it's all to do with just how they're structured.
Yeah, and this is the assumption people make, which is, okay, you know what? I know I make bad decisions. I'm going to hire a professional manager. These people have years of experience in the bond market, and they're going to do the right thing. And that may be absolutely true and make no difference. And the problem is herd mentality. So we'll use 2008 as an example. The stock market goes down, and what happens? Interest rates start going through the floor, and bond funds go through the roof. Right? So you see your stock funds going down, bond funds are going up. Why is that? Well, it's simple supply and demand. People took money out of stocks and they put them into bonds. Well, if we're talking about a mutual fund, because of the way they operate, that means share creation, share redemption. So in the case of a bond fund, what we're doing is we're giving money to the manager when interest rates are really low. Right? So the stocks just crashed. We sold out. We go buy a bond fund. Here's some cash. Go buy bonds. That's their job. And interest rates are really low because we just had a crash. So what do? Well, they do what they're supposed to do. They buy bonds. And let's say that's at 0% or 1%. And then what happens? Well, time passes and the market recovers. Market starts to go up, and you're sitting here in this bond fund that's doing nothing. And actually, as interest rates start to rise, your bond fund falls in value. So you're over here watching stocks go up. Well, my bond fund's going down. I'm out of here. And so what do? Now that interest rates are high, we're taking money away from the bond manager. So this is the time when they're like, yes, I finally get to buy good bonds. And no, sorry, you actually have to sell bonds. And you don't get any new money to buy bonds. We're taking money away. You have to sell them at a bad time. And the manager has no choice. Money flows in and out of the bond fund. Make them do this.
Well, what's crazy is that it can get worse, and as bad as that sounds, one thing that people don't realize with these bond funds is that a lot of them are actually borrowing money.
And that's a really insidious thing that, if only they would have told me. Well, what happens? People go out and they look at bond funds and they look at the track record and they look at the yields, right? Well, this bond fund's getting 5 and that one's getting 7 in interest. And people automatically assume it's interest, it's safe, it's a bond. I don't need to worry about principal. All I care about is maximizing that interest. And so they go out and they buy the 7% fund. And the problem is what they've done is they've gone out and borrowed money to buy bonds. They're leveraging. So they actually have, $125 million worth of bonds on a $100 million portfolio because they borrowed $25 million as an example. And that allows them to get a higher yield. Well, what happens when the market panics and people start doing redemptions? They've got to sell those bonds at the time that the market is crashing, or the bond market in particular is crashing. And not only do they have to sell them, they have to recover the leverage as well. And so we've actually seen several funds go out of business completely due to a phenomenon like this. And one thing also to mention is, let's imagine everybody else sold and you were the guy who said, I'm going to sit around and I'm going to buy and hold. Well, guess what? We just sold all the good bonds, right? Because those were the ones that were liquid at the time that there was this panic redemption. So meanwhile, we're left with the stuff they couldn't move. So you doing the right thing of not selling and not panicking, not going with the herd, actually could hurt you worse.
Yeah, so that's one of the craziest things about these bond mutual funds is that you're just chained to everyone else's bad decisions. So what should be your safety blanket suddenly isn't so safe, and that lack of control gets even worse when you actually try to sell because you're stuck. Right when you need to move, you can't do anything. So the third issue is just the sheer lack of flexibility, which is just annoying because even if you know exactly what you want to do with your money, a mutual fund just locks you behind these unnecessary limitations and these archaic processes that basically just limit whatever you can do.
Yeah, it's really just this nuisance. I mean, you feel like you've got control. You log into your account, you can click sell, you can click buy. And what happens when you do that? Nothing, right? It puts an order in that you can buy or sell at 4 o'clock the next day, depending on when you did this. It's not real time. If the market drops at 10 a.m., you can't do anything. You have to sit there, wait for the bell to ring. Same thing's true if you're buying. When you make the decision to buy, you literally don't know what price you're going to buy at. Who does that? Who wants to say, that looks like a good investment, I'm going to buy, and I'm going to wait and wait and wait and wait. Okay, whatever price comes up, that's fine with me. Do you do that with a car? No, you don't, right? With mutual funds, you also lose access to standard investment tools. You can't do things like stop losses, covered calls. There's all sorts of things that you just can't do with a mutual fund that you should be able to. There's no reason this time and age that you have this sort of limitation.
It just traps you into this outdated system, strips away your options, and it just doesn't even make any sense anymore. So the question becomes, how do you actually stay invested without giving up all your control? Well, a lot of people stick with mutual funds just because it's what they've done, what they know. And hey, I've done this for the last 20 years. It's done well for me. But every day you wait is just another day you don't have control, and you're just limiting your future potential by being stuck into these like outdated contracts.
Yeah, I mean, I like to use the example of newspapers. Some people still get newspapers, I assume, but it's not like it used to be. Now, how do you get your news? The new way, right? Well, mutual funds have been around forever, and there are new things. We're talking about exchange-traded funds right now. They're not that new. They've been around for quite a while and gaining in popularity. And honestly, I think they're superior to mutual funds. You can invest in the same underlying holdings, but most of the time, they're way cheaper and better for taxes. And the key to an exchange-traded fund is right in the name, and they trade on the exchange like a stock. So most of the things you can do with a stock, you can do with an ETF. You don't have these outdated restrictions of waiting till the end of the day, not being able to do options, not being able to do stop losses or limit orders or whatever. You can do all that stuff with ETFs. And the biggest piece of it is peace of mind. It's the lack of redemptions and issuance that mutual funds have. So when I buy a mutual fund, I give money to the manager goes out and buys the underlying holding, whether that's a stock or bond. When I buy an ETF, I buy it from someone else. The manager doesn't get involved. The manager's decisions are not impacted by me panicking or buying or whatever I'm doing, and therefore they can do their job without outside influences. And you also don't have the problem when you sell your bond ETF that you do with mutual funds. Again, with mutual funds, when you sell, the manager has to sell bonds. When I go and sell my bond ETF, I'm not involving them. I'm selling to someone else on the exchange. The manager doesn't get inconvenienced. They don't have to make decisions. They don't have to sell and mess up the whole portfolio.
So getting your money out of mutual funds and into ETFs is a massive first step to taking back control. But having the right investments is only half the battle. You still need a plan to pull that money out safely without the fear of running dry. So check out this video next where we break down our favorite retirement income strategy, helping you generate reliable income today without forgetting about inflation tomorrow.